Who did it this month for $14 billion worth of gold? Stop looking at the price. It is the greatest tool of misdirection. Look at what the biggest, most well-funded and well-informed traders in the globe are doing. Central banks, the commercial banks, and whoever is standing for delivery here. The delivery betrays the price. The delivery betrays everything, because if it was just about price, then the central banks are no dummies. They wouldn't be buying it. The Chinese are not dummies. They wouldn't be buying it. Central bank purchases that they only purchase 16 tons. World Gold Council says, no, it's 15 times that much. What are you talking about? 15 times that much. So they're like it's 160 tons. Central banks have been buying in what is a inelastic manner. They don't care what the CPI is. They don't care what the employment numbers are. They don't care what anything is. Every single month they've been buying, and they're using the price to misdirect. I don't think a gold revaluation is something that we should all count on. Got percent earlier saying I'm going to remonetize the balance sheet of the United States. You got Trump saying it's the golden era.
What do you think is drawing in that new crowd of people? Is it those high gold and silver prices that we were seeing toward the end or beginning of the year? Or is it more an understanding of what's behind those price increases?
Yeah, I think that's the bigger issue. It's not the prices. Prices are a tool of misdirection. That was the name of my presentation today. Prices misdirect. And I think instead fundamentals should be driving everything. Problem is the fundamentals are blurred and hidden by the mainstream, who really don't talk about what's happening. I mean, I'll give you an example. In the month of June, we saw $14 billion worth of gold delivered on COMEX. $14 billion delivered on COMEX. Now, not all of it left the COMEX market. It doesn't matter. This is a market that was typically predicated on for decades on the belief or understanding that investors wouldn't stand for delivery. They would cash settle, they would roll forward, or they would exit the position. It was done to hedge, not to speculate, largely. A miner, as an example, here at the conference, who has their production coming due, will forward sell it on COMEX to hedge. They're happy with the price, they'll hedge it. Or a company like mine, who has 2 million ounces of silver in a warehouse to sell, will hedge the 2 million ounces. I'm not going to stand for delivery. I'm using it to offset risk. And when the inventory is sold, then I close out that position.
What if the biggest financial threat isn't another recession, but a global shift that could change the way money is valued? While millions of investors are watching gold and silver prices, Andy Schectman says they're looking at the wrong signal. Behind the scenes, central banks continue buying gold. Physical bullion is being accumulated, and institutional investors appear to be positioning for long-term uncertainty. With rising government debt, persistent geopolitical tensions, and ongoing concerns about inflation and currency stability, one question stands out. What do the world's biggest buyers know that most investors don't?
So what we're seeing now is massive deliveries. And it's been going on for 18 straight months. In February, we saw 4.1 million ounces of gold delivered for almost $20 billion. For 18 straight months, every single month, it's delivery, which is so far an outlier to anything I've seen in 35 years, and nobody in the mainstream talks about it. So the public doesn't quite get it. I think it's less to do with the price of gold. In my mind, as someone who's watching it from this side, it's all about deliveries for the most informed players in the world. But for people who are here for the first time, it's not that. I think it's a general sense of being uneasy with what's happening around the world. A lot of times you can't even articulate it. You feel this charge in the air that is uncomfortable, whether it be with what's happening geopolitically, wars around the world in particular, in the Ukraine and in Iran. Maybe it's fiscal irresponsibility. Maybe people see that the dollar isn't going as far as a result of inflation. Things are getting more expensive. I don't know. I think there is an awakening, largely because it just seems that for the last 6 years, everything's been a little inside out. Everything isn't just quiet and normal like it used to be. In fact, it just seems like every other day there's some event that just makes people stand back and take notice. Maybe it has something to do with that it's more about defensive posturing, looking at something that is often looked at as insurance, taking a look at it and opening your eyes to something other than the belief that the road to retirement is simply funded with mutual funds and stock certificates. And you look at the positioning on the S&P 500 as an example, you have the entire market being held up by 10 stocks, and that's generous. It's more like 7. And at some point you have to realize that, maybe this isn't super healthy, so maybe I should take a look at putting a little bit of money on the sidelines or into something more of a risk off and like precious metals.
Yes, I think there's a lot of things under the surface that could make somebody feel like things are not quite right. And I like your theme of price as misdirection. I think we can maybe unpack that a little bit more, because even at this event, I do find there is a lot of focus on price. Maybe people see this as more of a buying opportunity right now with prices lower, but there is still questions about, well, why are they lower? What is going on? What's wrong with gold and silver?
And the big money doesn't care about price. The Bank of International Settlements came out in February and commented on the price slam. And they said, look, this wasn't fundamental at all. This was structural. A lot of things happened at the same time. At the end of the year, typically at the beginning of the year, rather, you have what's called ETF rebalancing. And ETFs that have gotten way out of whack, they have to rebalance according to their prospectus. Well, silver and gold have been going straight up month over month over month over month, or week over week for sure, into the last several weeks of the year. The ETFs got way out of whack. They had to be rebalanced the first week, and it's a notorious time for commodity-backed ETFs that must be rebalanced. There's going to be selling, or in some cases purchasing, in this case, wicked selling. But the BIS more or less came out and said, which is the Bank of International Settlements, the most powerful bank in the world, they said, no, this was synthetic, this was structural, this wasn't fundamental, because not only do the ETFs have to rebalance that first week, the CME group, which is the COMEX, in their infinite wisdom, decided to hike margin rates by 300% into that event from early December until first week in January or so. Margin rates went up 300%. And that means that's the money you have to have as collateral inside of your account in order to speculate on these contracts. Now, if you're someone like myself or a mining company hedging, you still have to have the collateral up. If you're a speculator, same thing. To give you an idea what I mean by that, we'll typically have 2 million ounces of silver in our warehouse, and in early December, it was roughly $15,000 to hedge 5,000 ounces. I'm a speculator. I want to buy a silver contract that's 5,000 ounces, 5 1,000-ounce bars. $15,000 approximately in your margin account, collateral just sitting there. Through a series of incremental increases, by the first week in January, that was $54,000. If you didn't post that money every time they raise margins, they would liquidate you within 24 hours. And the cost, if you had 110,000 in your margin account in December, that would allow you to buy 7 contracts. By 5 weeks later, those 7 contracts cost you 300% more. And if you don't have that money in your account, you're talking, $350,000+, you're liquidated, which selling begets selling, begets selling, begets selling. At the same time, the ETFs are rebalancing. Silver had gone straight up. Selling begot selling, begot selling, begot selling, and the margin increases, selling, selling, selling. And as they sell, all of the stops along the way are triggered. Begets more, gets more. Okay, so one would think that the price was collapsing. That means demand was collapsing. As that happened, as an example, China bought more silver in the first quarter of the year than at any time in the history of the country. In February, that's as the price got destroyed. They bought $54 billion worth of gold the first quarter as the price got destroyed. In February in the United States, 4.1 million ounces of gold delivered as the price got destroyed. That's $20 billion worth of gold. Someone stood for delivery, 5,000 an ounce, or pretty damn close to it. Even 4,500, call it 18, 19 billion, delivered as the price got kneecapped. Same month, which was a non-delivery month for silver, primary delivery month for gold, about 26 million ounces of silver were delivered, still very significant, but 39 million ounces got on trucks and left COMEX that month. That's 160% of what deliveries alone could explain in the month of February. That's 2.9 million pounds of silver worth almost $3-4 billion that got on trucks and said, buy. Now, who did that? Who loaded the trucks? Who ran logistics? Who put insurance on all this and where did it go? Who stood for delivery for nearly 20 billion worth of gold? Who did it this month for 14 billion worth of gold? And a lot is leaving, a lot is staying. When it stays, it moves from registered, which is the category that the bars are backed off of. In other words, the contracts say if you want to stand for delivery, that's registered. Eligible is an account whereby they could move to registered, they're eligible to be registered, but they're not for sale. We have 9 Brinks locations throughout North America that we have a storage program with. One is in New York. It's the only one that is a Brinks, or is a COMEX location. The rest of the Brinks vaults are not COMEX. This one happens to be. I have one client in particular that has 2 million ounces in 1,000-ounce bars at that location. It's ineligible. It's not registered. If she wanted to move them to registered, she could, but she has no intention of offering these to COMEX. So my point is, when the metal gets delivered, just because it's ineligible in the eligible category and not getting on trucks and driving away, like a lot of it has, doesn't matter.
Andy Schectman's biggest message is straightforward. Stop following the price. Start following the buyers. He believes daily price movements can be influenced by short-term trading, while the real story is unfolding in the physical market. One of the strongest examples he points to is the sharp increase in physical gold deliveries through COMEX. According to Schectman, more institutions are choosing to take delivery of actual bullion rather than simply settling paper contracts. In his view, that's a meaningful change because it suggests growing demand for direct ownership of precious metals. He also argues that temporary price declines don't always signal weaker demand. Market events such as ETF rebalancing, higher margin requirements, and forced liquidations can pressure prices even while institutional buyers continue accumulating physical gold. That's why he believes investors should look beyond short-term volatility and focus on long-term fundamentals. At the same time, the broader economic backdrop continues to keep gold in focus. Central banks have remained significant buyers as governments manage high debt levels. Investors watch inflation and interest rate expectations, and geopolitical conflicts continue to add uncertainty to global markets. These factors have reinforced gold's role as a long-term reserve asset for many countries. Schectman's core view is that institutional actions often reveal long-term trends before headlines do. Whether or not every prediction proves correct, he believes investors should pay closer attention to what central banks and major buyers are consistently doing, rather than reacting to every move in the price chart.
It's still being physically delivered where, like I said, the assumption forever was that no one would stand for delivery, that they would roll, they would settle, they would exit. Now they're saying, nah, I want the real bars. I want them in the numbered bars, and I would like them in my possession. Thank you. And if and when they leave, it wouldn't surprise me. But it's just one of these deals where I think you're beginning to see that delivery is being prioritized over paper promises. And that's a big deal because it's never happened before. It's a very big deal because ask yourself, for 18, 19 straight months, who the hell's got this kind of money? Who the hell's got $14 billion in June? As the price is doing nothing but disappointing. But all of these massive accumulations, whether it be central banks around the world, Poland, who's bought more gold than anyone in the world, with the only one who's even been close to them is Tether for the last 2 years, believe it or not. But all of these, Poland or China or India or any of these countries, how about France repatriating all their gold from the New York Fed, or India repatriating all their gold from the Bank of England? They would do that because Bank of England is attached to the LBMA, and New York Fed is attached to COMEX. But this follows the Dutch National Bank, the Bundesbank of Germany, the Bank of Austria, Hungary, Turkey, the Polish National Bank, the Czech National Bank. All of these banks said to the West, we'd like our metal back. We'll forego the convenience of the COMEX or the LBMA. We want it back. But that goes on top of 3 years in a row of 1,000 metric tons or more being purchased by the central banks. And they're a bunch of liars because they told us first quarter of this year, which by the way was the largest first quarter ever in history of central bank purchases, that they only purchased 16 tons. The World Gold Council says, no, it's 15 times that much. What are you talking about? 15 times that much. So they're like it's 160 tons or whatever the number was. Whatever 16 times times 15, that was the number they came and said, you've underreported by 15 times, 200 and whatever. The point of it is that the central banks have been buying in what is a inelastic manner. They don't care what the CPI is. They don't care what the employment numbers are. They don't care what anything is. Every single month they've been buying, and they're using the price to misdirect. And the fact that no one has the integrity in the mainstream to say, who the hell has stood for delivery? Again, every month, Charlotte, for 18 or 19, since Trump won the election last November, every single month there's been between 9 and 10 figures of gold and silver delivered. Who's doing it? Why does no one ask? And it is so far outside of what is normal. In the 35 years I've done this, less than 1% of any of these contracts stood for delivery. But that narrative is being rewritten in a very, very, very big way, and it's being done so very quietly, and no one's talking about it in the mainstream, and that's why the public just doesn't get it. July 4th was a bummer, and look, you know, when you take all of the things around us, you got Scott Bessent earlier saying, I'm going to remonetize the balance sheet of the United States. You got Trump saying it's the golden era. You know, you got Judy Shelton saying, his advisor, his nominee to run the Fed saying, yeah, July 4th, we've talked about it all the time. When you see all the gold being delivered on COMEX, when you see all the gold that is being accumulated by the global south, it just made sense. And I will tell you, I think it was the best idea I've heard ever. To date, I would say, to date, it is the best idea I've heard. And I think it should happen. And I think it might happen. Should it have happened July 4th? Well, that's what we all wanted, and that's what Judy thought it would. That doesn't mean it's not going to happen. I don't think a gold revaluation is something that we should all count on. Maybe they market to market, as they should. They should at least market to market on their balance sheet, which would give the Treasury General account $1 trillion free and clear. That's the accounting. But, you know, the fact that it didn't happen July 4th was a bummer to the industry. But, again, I don't think it's the end of the story. It's just another series of slight disappointments for people in this industry. But, you know, through it all, gold and silver seem to have found a way to outperform almost everything since I've known you. And there's been bumps in the road and volatility and white knuckling and nauseated, counterintuitive price action for a long time. But in the end, it's like the tortoise finds a way to get to the finish line before the hare. I'm not saying that happens all the time. And I want to make it clear, you own gold and silver not to become wealthy, but it is wealth that has outlasted 2 world wars and German hyperinflation and the Great Depression and every pandemic and everything. And here we are 6,000 years after it was named 700 times, or they, gold and silver, cumulatively, were named 700 times plus in the Bible. And the most well-informed and well-funded traders on the globe, whether it be the central banks, who have bought for really 9 years in a row, but are escalating those numbers and not being forthright about it, called out by the World Gold Council, or whoever's standing for delivery in billions every month, gold and silver, these people seem to know where the puck is going. And I think that's what they're doing. They're skating to where the puck is going, not where everyone sees it right now.
Well, I think that's a great place for us to wrap up, unless you had any final brief thoughts to leave with investors. Yeah,
that's good. I think the most important thing is that for people to look at this as wealth and stop looking at the price. It is the greatest tool of misdirection. Look at what the biggest, most well-funded and well-informed traders in the globe are doing. Central banks, the commercial banks, and whoever is standing for delivery here. The delivery betrays the price. The delivery betrays everything, because if it was just about price, then the central banks are no dummies. They wouldn't be buying it. The Chinese are not dummies. They wouldn't be buying it. And you think as the price is getting kneecapped for the first quarter, that whoever stood for delivery for almost $20 billion in gold in February, who took 39 million ounces out of the COMEX in silver in February, or the first quarter in China, most silver ever accumulated, or 54 billion in gold. These people know what's happening, and they're using price to run cover for it. And either you see that logically and look at the facts behind it, or dismiss it. That's the tough part, and it's never easy. But I think these people make it easier by their actions because they have the information. Certainly when you're spending 9 and 10 figures a month, you would think you have that info.
Andy Schectman's message is clear. Don't let short-term price swings distract you from the bigger picture. Watch the actions of central banks, institutional investors, and the physical gold market, because those trends may provide important clues about where the global economy is heading. If you enjoyed this analysis, subscribe now, turn on the notification bell, and hit the like button for more in-depth coverage of gold, silver, investing, and the global economy. We bring you the stories that matter before they become mainstream. Now, it's your turn. Do you believe central banks are preparing for a major financial shift, or do you think this is simply another cycle for gold and silver? Share your thoughts in the comments below. We'd love to hear your perspective. Thanks for watching, stay informed, stay prepared, and we'll see you in the next video.